Good afternoon, traders. I'm Himalay Bhatia from the Financial Analyst, and I welcome you to the Bold Project. In this module, we have been discussing about the Dow theory. We have covered the first and the second principle. In this episode, our focus will be on the third principle. The third principle says that the primary trend has three phases. All right. The first being your accumulation phase, the second being your participation phase, and the third being your distribution phase. Now, let's first talk about what the accumulation phase is. Now, what happens during the accumulation phase is that, the prices of the stocks are very cheap. All right. And I'm not talking about one particular stock. It is the market in its entirety is at its low. All right. Now, what happens if the prices are cheap? What is the human tendency? The humans tend to buy the stock, right? But in this case, it is something else. Despite the prices being cheap, the people do not buy the stock in this phase. Why is that happening? So let's take a look at the charts. I have opened up HDFC Bank monthly charts over here for explaining you why the market participants do not buy the stocks even when the prices are very cheap. So, do you see this flattened out part at the bottom of the chart? I'll just draw using a trend line. This is known as my accumulation phase. Now what are we basically doing in a technical analysis? We are looking back into the history and analyzing what has happened in the past. So let's use the same approach over here. What has happened just before the accumulation phase due to which people are not buying the stock? So right before the accumulation phase, there has been a downtrend in the market. All right. Now, downtrends do keep occurring in the market. So what is the big deal in this case? So let's look at the time frame. So at the bottom, you can see that this had started around November 2007 and the downtrend had continued around till November 2008. So firstly, this is your 2007-8 crisis. All right. Now, just imagine this. The stock prices have been falling for nearly a year. And after that 1 year is completed, will you be buying your stocks in the market or will you be entering the market at that given point in time? No, obviously not, right? Because you will be protected about your capital. You will think that the markets are yet to fall further down, and only once there is some stability in the market, only then you will plan to enter into the markets again, right? So, what happens is the market participants become pessimists in the markets. So, what is the significance of this accumulation phase? The significance of this accumulation phase is that there is a certain group of people who do enter into the markets in this given phase, and they are termed as your intelligent investors. Now, who are your intelligent investors? They are people who feel that there will be a recovery in the economy from that given point in time, and they are optimistic in the markets. All right, so let's give you an example. Mr. Rakesh Jhunjhunwala, right? The big bull of the market. Now, what he does is when he enters into the markets, it's not that he wakes up one fine morning, opens investing.com, looks at a few charts, and say that, all right, I will be buying the stock over here today. No, that is not happening with him. Why? Because once he is entering in the market, he enters with a huge capital, right? So, what does he do? So, in such a scenario, what he will do is he will approach the board members of the company, he will set up a meeting with them, and in the meeting, what he will do is he will be asking them questions like what plans or what strategies has the company come out with to recover from this crisis like situation, right? So on and so forth. He will be taking down every detail about the company, and basis that, he will be coming up to a conclusion whether or not he should be entering into the stock. All right. Now, what happens if retail traders like you and I approach the board members of a company? Trust me, we will be kicked out of the company the next minute. Why? Simply because our capital is not even making a dent in the market. Thus, these big bulls, these big people in the market are someone who are entering in the accumulation phase. So, who other are our intelligent investors? So, similar sort of HNIs, where HNS stand for high net worth individuals. Your FIIs, your DIIs, they are nothing but your foreign institutional investors and your domestic institutional investors, and they are your mutual fund agencies, your insurance companies, etc., etc. And also the government. The government also takes part in the market. All right. So these people who have a huge capital and have detailed access to the company's information, and they also have access to the information about the economy at a whole, they are known as the intelligent investors, and they are usually the people who enter at such periods, buying the stocks at a very, very cheap price. All right. So this was the accumulation phase. Now, when does the accumulation phase occur? An accumulation phase always occurs after a crisis-like situation, a huge natural calamity, something like a Great Depression, etc., etc. So anything which has heavily impacted the economy, after that there will be an accumulation phase in the market, where not all market participants take part, only a certain group of people do, and they are known as your intelligent investors. All right. We will be discussing about the participation phase and the distribution phase in the next episode. So stay tuned. Thank you.